My name is still Aaron Klein. I'm still a fellow in economic studies and policy director on the Center for Regulation and Markets, and it is still a rainy Wednesday afternoon, and you all are still in the room. So thank you for choosing to spend your time with us discussing what I think is a very important issue precisely because it is not a topical issue, which is what to do and whether we are prepared to and have incorporated the lessons from the prior recession on what to do should a domestic but still large, not giant, not one of these globally systemically important financial institutions, but a large and important domestic institution run into trouble. I want to talk about it now, and I'm so thrilled that we're joined by and to receive the wisdom from many of our speakers now when everything looks fine. And I'm going to start by asking everybody here kind of to introduce the topic, a question which was, what was the first year in American history in which not a single bank failed? The answer to that question may surprise you. It was not until 2005 that America experienced a calendar year without a single bank failure. In fact, from the period of 2004 to 2007, for 32 months, not a single bank failed. It was the longest period like that in American history, featuring not one but 2 years without a single bank failure. At the time, I can recall many bank regulators talking about what a successful job we'd been and how wonderful the banking system in the United States was, as evidenced by no bank failures. I think all of us in the room can appreciate that 2005 and 2006 were not the apex of safety and stability in the U.S. financial system. It remained that way. In fact, after the Great Crisis, between 2013 and 2017, a small but a decent number of banks failed every year. I define this as less than 25. 2018, however, marked only the third year in American history when not a single financial institution failed. And there has been one failure so far in 2019 of a bank. I won't get into its exact root causes of failure, but it was just one, and it seemed like it was tremendous amounts of fraud. And so it is, I think, precisely during the period in which all institutions are seemingly doing well together that it's important to consider, are we prepared for a scenario in which many institutions, particularly some that are sizable, are not? And I can think of no better person to lead us in that conversation than Martin Gruenberg. Marty has been at the FDIC board, serving as chairman, vice chairman, currently a member of the board for 14 years now. Prior to that, Marty was involved in every major piece of financial services legislation that occurred for a generation, going back to and through the cleanup of the last great wave of bank failures and the savings and loan crisis that spawned the reforms of FDIC and FIREA, which ultimately reshaped the agency upon which now he serves. Prior to that, Marty's distinguished experience in the United States Senate and in the Congress. He's a graduate of Case Western and a fellow Princetonian, and Marty's career and his public service, both in Washington and through the FDIC, fundamentally globally, where he's headed and served on multiple agencies to help spread the importance and value of deposit insurance and financial services resolution capability and authority in a global context, really embodies the Princeton motto of service of this nation and the service of all nations. So join me in welcoming Marty both to Brookings and thanking Marty for his fantastic work so far at the FDIC as we hear from him what we ought to be thinking about the potential problems in the resolution of a large domestic financial institution. Thank you, Marty.
Oh, I should quit while I'm ahead, I think. Aaron, thank you for that very generous introduction. There is a certain symmetry, I have to confess, if not deja vu, because I did join the board of the FDIC in August of 2005, and the FDIC had, at that time, gone through the longest period in its history without a bank failure. And when I was seeking the nomination to the board back then, this is true. Somebody asked me, well, why do you want to go to the FDIC? You know, nothing's happening in the banking industry. You'll be bored over there. You won't have anything to do. And I said at the time, you know, I don't really need a financial crisis to be interested in banking regulation. And all things being equal, I would just as soon not have a crisis occur if I have the privilege of serving on the board of the FDIC. And that was August of 2005. And then 2006, we really had the first inklings of problems in the mortgage market. 2007, we had a full-scale meltdown of the mortgage market in the United States. In 2008, we were in the midst of a near catastrophic collapse of our financial system, followed by the most severe recession since World War II. And I must say, there is a certain sense of deja vu when Aaron referenced, and we did not have a bank failure in the United States in 2018. In fact, we went through an 18-month period without a bank failure until a small institution in Texas failed earlier this year. So, you know, you would think the lack of bank failures would be a reassuring sign. I must say, for me, it's as much of a red flag as anything else, particularly at this late stage of an economic recovery with the buildup of underlying risks in the financial sector and the possibility of a downturn, you know, at some point. I couldn't resist that, referencing that with Aaron's introduction, but certainly the subject I want to talk about today is relevant to all of that. So let me begin by thanking Aaron and the Brookings Center on Regulation and Markets for inviting me here today. The subject I'd like to discuss, the resolution of large regional banks in the United States, as Aaron pointed out, has received relatively little attention during the 10 years since the financial crisis of 2008-2009. Most of the attention, appropriately, has been on the challenges posed by the resolution of global systemically important banks, the so-called GSIBs. However, regional banks, which for the purposes of today's discussion I'll categorize as banks with assets between $50 and $500 billion, pose very significant resolution challenges to the FDIC that are quite distinct from those posed by the so-called GSIBs and quite distinct from the smaller community banks. Their size, complexity, reliance on market funding, and uninsured deposits would present very substantial risks in resolution with potential systemic consequences. So I view today's program as an opportunity to have a public discussion about the risks and challenges presented by the resolution of large regional banks. Now, in order to establish a common baseline of understanding for our discussion, I'll begin with a brief description of the FDIC's resolution process under the Federal Deposit Insurance Act, just to set the framework. I'll then discuss the distinct and underappreciated challenges posed by the resolution of regional banks. And finally, I'll conclude with an overview of the actions taken by the FDIC to date to address these challenges. So let me begin just with the nuts and bolts of the FDIC's resolution process under the Federal Deposit Insurance Act. Now, under the FDI Act, the FDIC has the exclusive authority to act as the receiver or the liquidating agent for failed federally insured depository institutions. Now, as the FDIC's resolution handbook describes, when a bank fails, the chartering authority typically revokes the bank's charter and appoints the FDIC as receiver. They basically hand the failed institution over to us. The chartering authority is the Office of the Comptroller of the Currency, the OCC for nationally chartered banks, and the state banking regulator for the state chartered institutions. Now, prior to failure, the chartering authority notifies the FDIC that the bank is in trouble. There's, of course, a supervisory process that may already be underway to avert the failure of the institution, but for the purpose of the discussion today, we're going to assume that the bank will fail. Since the passage of the Federal Deposit Insurance Corporation Improvement Act of 1991, for those of you in this business, that's FDICA, the FDIC has been required to choose the resolution method as a matter of law that's least costly to the FDIC's Deposit Insurance Fund. This is a so-called least cost test. Now, as a general matter, the FDIC has two options for the resolution of a failed bank. First, the FDIC can sell some or most of the assets of the failed institution to a healthy acquiring bank, which would generally assume all the deposits or only the insured deposits of the failed bank, along with some or most of the remaining liabilities. This is generally called, and I'd like you to remember this term, a purchase and assumption transaction. It'll figure into the later discussion. P&A, purchase and assumption. Those assets and liabilities not included in the transaction remain behind in the receivership administered by the FDIC. Now, second term I want you to remember, a special type of purchase and assumption transaction that is used when additional time is needed to market a failed bank is a bridge bank. Purchase and assumption and bridge bank. Although a bridge bank is not commonly used, it has particular application to the resolution of a large regional bank. So I'm going to come back to that as well. A bridge bank is a bank chartered by the OCC and temporarily owned and operated by the FDIC to, quote, to bridge the time between the date of failure of the institution and the date of sale to another acquiring bank. A bridge bank is established only if it is projected to be the least costly resolution alternative for the Deposit Insurance Fund. And before establishing a bridge bank, a cost analysis has to show that the franchise value of the bank, of the failed bank, is greater than the marginal cost of operating the bridge institution, thus being less costly than a payout of insured deposits. And this is where it becomes relevant, particularly to the regional institution. A bridge bank may be utilized when a troubled bank fails suddenly, generally because of liquidity issues, preventing timely marketing of the institution, when the failed bank is too complex for potential bidders to conduct due diligence in the normal time frame to submit a bid that accurately captures the franchise value of the failed institution, or both. These are the reasons the bridge bank option has particular applicability to large regional banks, and I'll come back to these points on complexity and liquidity. If the FDIC does not receive any acceptable bids for a purchase and assumption transaction, or the bridge bank is not the least costly option, then the FDIC will execute what's called an insured deposit payout, which is the second option available to us in resolution. In an insured deposit payout, the insured deposits are paid in full, and all assets and the remaining liabilities of the failed bank go into an FDIC receivership for liquidation. So since 2007, the onset of the financial crisis, the FDIC has served as receiver for over 525 banks. Only 9 of these failed banks had assets over $10 billion. 9 of the 525. The overwhelming majority, over 98%, had assets under $10 billion. It tells you which banks have failed during this crisis and post-crisis period. Approximately 95% of resolutions conducted by the FDIC since 2007 involve purchase and assumption transactions, generally involving a single acquirer, assuming nearly all of the failing bank's liabilities. This resolution approach, particularly applicable to community banks, is generally the least disruptive, both to the depositors in the local community and the easiest for the FDIC to execute. Only 25 banks since 2007 were resolved through insured deposit payouts, reflecting the general availability of acquirers for purchase and assumption transactions for these smaller institutions, which were the overwhelming majority of banks that failed during and after the crisis. In only 3 resolutions since 2007 was a bridge bank utilized, and only 1 of those 3 cases involved an institution with assets over $10 billion. And this really leads into the discussion of the challenges posed by the failure of a large regional bank and why it is really quite distinctive from the community bank resolutions, which were really the overwhelming number of resolutions done by the FDIC in this post-crisis period. So let's talk about regional large bank resolution. As of the second quarter of this year, there were 39 banks in the United States with total assets between $50 and $500 billion. Collectively, those banks hold about $6 trillion in assets, or nearly 33% of banking industry assets. So they are a big portion of the banking industry in the United States. They hold $4.3 trillion of deposits, or about 31% of total deposits. And those deposits are held in 189 million deposit accounts. Now, of those deposits, 1.8 trillion, approximately 43% are uninsured. That's based on both the average and the median. Both the average and the median are right around 43%. These uninsured deposits typically would include business payroll accounts, deposits from large not-for-profit institutions, and individuals with large balances, such as retirees. The size of these institutions, by definition, limits the universe of banks with the capability to acquire them if they fail. I mean, this is pretty self-evident. The criteria used by the FDIC to select potential bidders include asset size, capital level, regulatory ratings, geographic location, and minority-owned status. Even a $50 billion bank would be a substantial acquisition for a very large bank to absorb. At the top of this scale, at $500 billion, likely only a global systemically important bank, one of the 8 GSIBs, would have the capacity to make such an acquisition. So we are talking about a limited universe of potential acquirers. And remember, the purchase and assumption, traditional purchase assumption transactions, which are 95% of the crisis and post-crisis resolution, are dependent on an available acquirer. Given the limited number of banks with the capability to acquire a failed regional bank through a traditional purchase and assumption transaction, there is a significant possibility, if not probability, that the FDIC would have to establish a bridge bank to manage the orderly failure of such an institution. In managing a failed regional bank through a bridge bank is a very different ballgame than when you have an acquirer, and would pose a number of challenges to the FDIC. Some of these challenges would also apply in the P&A purchase and assumption transaction, but certainly apply to a bridge bank. First, and let me just walk through these, even though regional banks generally don't have the extensive international operations and diversified non-bank business lines that characterize the global institutions, the GSIBs, many of these regional banks nevertheless have large branch networks, substantial IT systems, and millions of account holders. This complexity, certainly as compared to the smaller community banks, would make the management of a bridge bank a very significant operational challenge for the FDIC. As somebody who sat on the board, and I'm going to come back to this during the crisis, take my word for it. Second, regional banks rely to a greater extent on credit-sensitive market funding than smaller banks. They are thus more susceptible to a rapid failure caused by a lack of liquidity, greatly complicating an orderly resolution. Third, the sheer volume of accounts held by these institutions would pose a large challenge to the FDIC to make a rapid determination over the famous weekend after failure of the institution as to which accounts were insured and which accounts were not. And believe me, that matters. As of the second quarter of 2019, these regional banks had an average of 4.8 million deposit accounts, with 27.4 million deposit accounts at the institution at the top of this range. A rapid determination and payment of insured accounts is essential for an orderly resolution. Fourth, unlike the global institutions which are required to maintain a minimum amount of long-term unsecured debt to absorb losses in the event of failure, regional banks are not subject to such a requirement. As a result, there is significant variability in the holdings of unsecured debt by regional banks. On average, these banks hold $3.9 billion in long-term unsecured debt, which is about 2.5% of total assets. While 5 of these banks hold long-term unsecured debt of 4.5% or more of total assets, 8 report no long-term unsecured debt. So depending on the institution, a buffer of unsecured debt to absorb losses in resolution might or might not be available. And finally, the heavy reliance of these institutions on uninsured deposits would pose a very significant resolution challenge. As I mentioned, the most recent call report data indicate that on average, about 43% of the deposits at regional banks with assets between 50 and 500 billion are uninsured. Although the FDIC's resolution experience indicates that call report data generally overstate the volume of uninsured deposits to some degree, it is nonetheless clear that regional banks have a heavy reliance on uninsured deposits for funding. In a resolution where there is no acquiring institution and possibly little or no unsecured debt to absorb losses, it is likely that the least cost test would require that uninsured depositors take losses. Given the heavy reliance of regional banks on uninsured deposits, uninsured depositors taking losses at a failed regional bank could have knock-on consequences for other regional banks, particularly in a stressed economic environment. So we have two examples from the financial crisis that illustrate pretty clearly the risks I've just talked about. One is Washington Mutual Bank, and the other is IndyMac Bank. And let me walk through those two examples because they pretty well illustrate what I've been talking about. Now, Washington Mutual, with over $300 billion in assets at the time of its failure in September 2008, was the largest thrift institution in the United States at the time and the sixth largest insured depository institution. Its failure was the largest in the history of the FDIC. Several factors made it possible for Washington Mutual to fail with no loss to the Deposit Insurance Fund and no loss imposed on its $45 billion of uninsured deposits, which was approximately 24% of its total deposits at the time. First, there was an acquirer for Washington Mutual with the capacity to assume all the assets and all of the deposits, both insured and uninsured, of the failed institution through a traditional purchase and assumption transaction. Second, not only did the acquirer have the capacity to undertake the transaction, but because it had attempted to acquire Washington Mutual on an open institution basis, meaning before it failed, prior to the failure, the acquirer had already done the due diligence necessary to enable it to act quickly when Washington Mutual finally failed. This is really a critical point. And third, Washington Mutual had a substantial volume of unsecured debt, $13.8 billion of unsecured debt, 4.5% of its total assets, which was available to absorb losses in resolution. I got to tell you, the word luck does come to mind here because there was nothing inevitable about this. This loss-absorbing capacity was essential to meeting the least cost test and for uninsured depositors to avoid taking a loss. If these factors had not been in place at the time of Washington Mutual's failure, the FDIC likely would have had to establish a bridge bank and take over the operation of the failed institution. The failure of Washington Mutual in that scenario would have wiped out the Deposit Insurance Fund, and uninsured depositors would likely have had to take a loss in order to meet the least cost test. Given the stressed economic and financial environment in September of 2008, those of you who are around remember September of 2008, when Washington Mutual failed, imposing a loss on $45 billion of uninsured deposits at that moment could have had a significantly destabilizing effect. The only way to avoid that outcome would have been for the FDIC to exercise the systemic risk exception available under the Federal Deposit Insurance Act in order to set aside the least cost test. That, needless to say, would have been a very difficult judgment to make and illustrates the potential systemic risk associated with the failure of a large regional institution. Now, the risks of a regional bank resolution are illustrated further by the failure that occurred in July of 2008 of IndyMac, which was a $30 billion thrift. So IndyMac was $30 billion. Washington Mutual was $300 billion. When IndyMac failed, there was no viable acquirer. IndyMac's franchise value was pretty much zero, and it had no unsecured debt. The FDIC had to establish a bridge bank, impose a loss on $2.6 billion of uninsured deposits, which was about 14% of the total deposits of IndyMac at the time, and then manage the failed institution over a 9-month period, during which the failed institution was partially wound down and eventually sold. The lack of public familiarity with the failure of an institution of even this size was enough to cause a local reaction, and lines around the institution on the Monday after failure. IndyMac turned out to be the most costly failure in the history of the FDIC, resulting in a $12.4 billion loss to the Deposit Insurance Fund. So look, the lesson here is pretty clear. A $300 billion bank could fail without cost to the Deposit Insurance Fund and no losses to uninsured depositors, so long as there was a viable acquirer who could undertake an all-deposit purchase and assumption transaction and unsecured debt available to absorb losses. However, a $30 billion institution which had no unsecured debt and for which there was no viable acquirer resulted in the largest loss to the Deposit Insurance Fund in the FDIC's history, losses to uninsured depositors, and frankly, some reaction in the local community. So anyone who thinks that the failure of a regional bank is like a failure of a community bank is not paying attention. We have real-world experience that was very tough and frankly enlightening. Now, since the financial crisis, the FDIC has undertaken a number of initiatives to enhance its ability to manage the orderly failure of a regional bank, including through a bridge bank if necessary, which is a probable, if not a possible, if not likely scenario for one of these institutions. Since 2011, the FDIC has, by rule, required banks with assets over $50 billion to prepare resolution plans for the insured depository institution, for the bank, as a complement to the holding company resolution plan that's required under Title I of the Dodd-Frank Act. And these IDI plans are really quite important, particularly in the case of the regional banks. The preamble to the 2011 rule stated the purpose of this requirement. The rule requires a limited number of the largest insured depository institutions to provide the FDIC with essential information concerning their structure, operations, business practices, financial responsibilities, and risk exposures. The rule requires these institutions to develop and submit detailed plans demonstrating how such insured depository institutions could be resolved in an orderly and timely manner in the event of receivership. So first, resolution plans for the IDIs. Second, in 2014, the federal banking agencies adopted a rule implementing a quantitative liquidity coverage ratio. A company subject to the rule was required to maintain an amount of high-quality liquid assets that is no less than 100% of its total net cash outflows over a prospective 30-day calendar period. This rule applies to bank holding companies and insured depository institutions with $250 billion or more in total assets. The Federal Reserve also adopted a modified liquidity coverage ratio standard based on a 21 calendar day stress scenario that applied to bank holding companies with total consolidated assets between 100 and 250 billion. This rule, like the resolution plan rule, was based on the experience from the financial crisis that the liquidity failure of a large banking organization can occur fast, very quickly. High-quality liquid assets, sufficient to provide a 30-day runway before failure for institutions with assets over 250 billion, and a 21-day runway for institutions with assets between 100 and 250 billion, were important requirements from the FDIC's perspective, given the risks associated with the failure of institutions of that size and the value of the FDIC to having an assured minimum time of preparation before the failure of such institutions. When they talk about a runway of 30 or 21 days, where do you think that runway leads to? It leads to the FDIC. So from the FDIC standpoint, having at least a little bit of breathing room before one of these institutions comes down is pretty important. Now, finally, in November of 2016, the FDIC adopted a rule requiring institutions with over 2 million deposit accounts to improve the quality of their deposit data and make changes to their information systems so that the FDIC could make a rapid and accurate deposit insurance determination to facilitate the prompt payment of FDIC-insured deposits when large depository institutions fail. This is job one for the FDIC, making good on insured deposits. As the preamble to that rule pointed out, and I quote, "Prompt payment of deposit insurance maintains public confidence in the FDIC, the banking system, and overall financial stability." The rule applies to 23 of the 39 institutions with assets between 50 and 500 billion. And I want to read this other quote to you. The preamble to that 2016 rule stated the broad policy concern that led to its adoption, consistent with the resolution plan and liquidity coverage ratio rulemakings. And this is the quote. "While the likelihood of any particular covered institution's failure may be low at a given point in time, history suggests that the financial condition of institutions that are perceived to be in good health can deteriorate quickly and with little notice. In 2008 and 2009, several large insured depository institutions failed, including IndyMac Bank and Washington Mutual Bank." You can see the impact those experiences had on the FDIC. In general, very large IDIs, insured depository institutions, rely on credit-sensitive funding more than smaller IDIs do, which makes them more likely to suffer a rapid liquidity failure. That was from the preamble to the 2016 rule. In addition to these rulemakings, the FDIC has been focused internally on planning for the resolution of a large regional bank because of the risks I've just talked about. Now, if I may say, based on the work done, an area where additional rulemaking might be prudent to facilitate the orderly failure of a large regional bank would be an unsecured debt requirement to assure a comparable measure of loss-absorbing resources in resolution for these institutions. As I indicated, there is wide variability in regard to this among the regional banks. Now, unfortunately, instead of further measures to strengthen the FDIC's capabilities, there have recently been a number of measures finalized or proposed that would weaken or remove the requirements of these rulemakings, and for the record, I thought I should state them. In July of this year, the FDIC approved a final rule to allow banks with $2 million or more deposits to delay from 2020 to 2021 their compliance with the requirement to improve their data and reconfigure their systems to support the FDIC's ability to make rapid deposit insurance determinations in the event of failure. This additional year extended the original 3-year compliance period in the 2016 rule, which took effect in April of 17. The final rule also weakened the compliance requirements that have been established to assure effective implementation of the rule. In April of this year, the FDIC issued an advance notice of proposed rulemaking that, while identifying the risks associated with large bank failure, nevertheless seeks comment on a number of proposals that would weaken the current resolution plan requirements for insured depository institutions. For example, alternatives put forward for comment in this advance notice of proposed rulemaking would reduce the resolution plan content requirements for these largest insured depositories, reduce the frequency of resolution plan submissions, and eliminate the IDI plan altogether for the smaller insured depository institutions above $50 billion in assets. Now, just yesterday, the FDIC board voted on 2 final rules. The board adopted a joint final rule with the Federal Reserve that would eliminate the Dodd-Frank Act Title I resolution plan requirements at the holding company level, with one exception for institutions with assets between $100 and $250 billion. And it would require the submission of such plans for institutions with assets between $250 and $500 billion just once every 3 years, with a full plan required every 6 years, rather than every year as is now the case. And in a separate joint final rule with the Fed and the OCC, the FDIC board approved yesterday eliminating, with one exception, the liquidity coverage ratio for banking organizations with assets between $100 and $250 billion, and leaving in place a liquidity coverage ratio for banks with assets between $250 and $500 billion that would only be 85% of the current requirement. Given the risks associated with the failure of large regional banks, these measures, frankly, are unwarranted and misguided. They only increase the challenges posed by the resolution of these institutions and the potential for disorderly failure, and they disregard the lessons of the financial crisis. So in conclusion, I want to again thank Brookings for the opportunity today to draw attention to the challenges posed by the failure of a large regional bank. As I indicated, I have been increasingly concerned that the attention that's been given to the failure of the global banks since the financial crisis, while entirely appropriate, may have obscured the risks associated with the failure of a large regional bank and permitted an unjustified sense of confidence to develop that the failure of such an institution would not be challenging. I believe the experience during the crisis of large regional bank failures such as Washington Mutual, or even a smaller $30 billion institution such as IndyMac, illustrates the very real risks a regional bank failure would present. Going forward, I believe that attention to this issue should be a top priority for the FDIC, the other federal and state bank regulatory agencies, and for the banking industry. Thank you all very much.
Should we go over there, grab thank you very much. In preparing for a set of questions in your speech, I was going through what some of your fellow regulators have said about this, and Federal Reserve Vice Chairman for Banking Supervision, Governor Quarles, said the following. I'd like your reaction to it, or maybe we may know your reaction, which is he said, quote, most firms with total assets between 100 and 250 billion do not pose a high degree of resolvability risk, especially if they're less complex and less interconnected. That isn't quite jibe with what I just heard.
Yeah. Can you all hear me? Yeah, when I talk about a justified sense of confidence in regard to the failure of one of these regional banks, I would think, candidly, that comment would fall in that category. And it's not theoretical or hypothetical. We had real experiences, and they were scary. Washington Mutual was scary. We caught a break. We caught several breaks with Washington Mutual. It could have been another inflection. It was bad. It could have been another inflection point for the crisis if it had gone another way. And IndyMac was, a huge challenge for the FDIC in every way. And that was a $30 billion institution, not a $300 billion institution. If we had to do for Washington Mutual what we had to do for IndyMac, I mean, it would have been a real, I was going to say challenge, a real problem. And so, if I have one point to make today, it is don't take it for granted. You cannot take, in some sense, if I may say, we handled all these hundreds of bank failures during and after the crisis, we being the FDIC, with little or no incident. And I worry a little bit that we've lulled people into a false sense of security. The almost all of those banks that failed were, small, relatively small community banks under 10 billion. If we had to deal with a large regional bank failure with some of the complexities I've talked about, it's a very different set of challenges with a far more significant set of risks associated with it. It's not that these risks are insuperable, but they need to be the focus of a lot of attention and planning and additional, as I mentioned, resources and capabilities for the FDIC.
So let's get into that a little bit, because you kind of paint a little bit of a Hobbesian choice, so to speak, that you can either have a failure in a bridge bank, like with what happened with IndyMac, which was at only a $30 billion institution, the costliest resolution in American history. You can get lucky and have a purchase and assumption that saves the deposit insurance fund, but a corollary of that you kind of mentioned in your speech but didn't delve into is, well, then the big get bigger, particularly when you talk about the upper end of the spectrum. That increases concentration in the system and ultimately can't be replicated ad infinitum.
Well, frankly, that's why I put such emphasis in the discussion on the bridge bank as a tool here for the resolution, because I think, when we're dealing with $100, $200, $300, $400 billion institutions, the FDIC can't assume that we're going to have an acquirer. If anything, for planning purposes, we really have to assume a bridge bank scenario. And so the issue here is to get better and more capable at managing an orderly failure of a financial institution utilizing a bridge bank. I think that is the core challenge for the FDIC. And I think we have that capability. I think we've taken steps post-crisis. The resolution plans, I believe, are critical. The liquidity coverage ratio is an important liquidity buffer. The ability to make the insured deposit determination and getting these institutions to develop the technological capability to deliver the information in a timely way to the FDIC in order to do that. Those are really critically important measures to facilitate an orderly failure of one of these institutions using a bridge bank if necessary. And I think we need to give some careful thought to this unsecured debt issue since it played such an important role during the crisis. So, I would hope the choice is not a Hobbesian one. I would hope the choice is a manageable one, but we got to work at it. It needs to be a top priority, and we have to certainly preserve the measures we've taken to strengthen that capacity post-crisis, and we may have to consider additional measures.
So I want to turn to the audience because there's some real experts in the room, but I want to also dig in a little bit on the resolution plan, which is frequently called the living wills, kind of a catchy turn of phrase. And some people make the argument that a living will is like your will. It's really important to do it the first time. It's important to do after major life events, but you don't need to update your will every year if nothing big has changed. And that seems to be somewhat of the logic behind the rules that, as you described, change the time horizon on living wills. So how would you respond to that argument that you don't need to update your will on an annual basis? Why should they update theirs?
Look, there's room for some accommodation there. I think our experience with the living wills suggests, going from an annual to a biannual, every 2 years submission would be pretty reasonable from the standpoint of the banks preparing the resolution plans and the standpoint of the agencies reviewing them. I do think for the institutions in the $250 to $500 billion category, going to a 3-year cycle with a full plan every 6 years, to me, that attenuates this process to an extreme, and a full plan every 6 years starts raising a question as to how meaningful and relevant the plan will be. And look, for institutions between $100 billion and $250, the Title I holding company resolution plan requirement has been discontinued, with one exception. And those $100 to $250 billion institutions are big banks, and those plans have a lot of value.
So let's also, one of the things that flagged in your speech, you talked about the complexity of IT systems, and sometimes I think we think that when we see an institution of that size, it's always been of that size. But the secret in American banking is we used to have 16,000 banks. Many of the institutions in that have grown through acquisition and organic growth over decades, which leads to some of the increased complexities in underlying systems below. If you had a $70 billion institution today and it grew through a combination of organic growth and acquisition, how big could it grow until it has to create a living will, and for how long would that last going forward? Because the ones that were originally captured from 1 to 250 at least had one before that requirement was removed. What does the outlook look like going forward in that context?
Let me tell you, a $50 billion bank's a pretty big bank already. And already pretty complicated with substantial IT systems, large numbers of deposits. And I would not take for granted the orderly failure of and the universe of potential acquirers at the 50, 60, or $70 billion level is pretty limited as well. So we require plans at the bank level, at the insured depository institution level from 50 billion on up. I would not want to give those plans up. I think those plans have value, and they enhance the FDIC's ability to manage the orderly failure of these institutions. I do not think the cost is enormous for the institutions involved, and the downside risk, based on experience, can be very high.
I know we could talk all day about this, but let's open up the conversation to folks in the audience. And please be brief and identify yourself and ask a question. Go right ahead.
Oh, thank you. Neil Rowland, MLX News. For those of us who are the opposite of experts, can you use some brushstrokes to depict, please, the scenario that would ensue or could ensue with a bank failure, particularly if these institutions are not so interconnected as Vice Chairman Quarles suggests?
Well, you know, we have the real-world example of Washington Mutual and the real-world example of IndyMac. And had Washington Mutual failed, Washington Mutual did fail, but we had an acquirer that made an all-deposit acquisition, meaning all of the depositors, insured and uninsured, were passed along to Washington Mutual, and no one took a loss. It was $45 billion of uninsured depositors. If in September of 2008, Washington Mutual had not been acquired, and we would have had to, we being the FDIC, would have had to take over Washington Mutual ourselves and own and operate it for a period of time. Couple of things. Uninsured depositors would likely have taken losses. The millions of uninsured depositors at other banks, I don't want to get carried away, but they might have taken notice that insured depositors at Washington Mutual were taking losses. And in September of 2008, were they positive their institution wouldn't get into trouble? And might not that have affected their actions in regard to their deposit accounts? If the FDIC had to assume the operational responsibility for that $300 billion thrift institution with a large branch network that was national in scope, that would have been a heck of an operational challenge for the FDIC. There were a lot of knock-on risks that the failure of a large regional bank could have posed to the financial system, certainly in that scenario, and even outside of an extreme crisis scenario. The interbank relationships of these large regional institutions, as well as the reliance on uninsured depositors, are significant risk factors. So all I'm saying is these are not your local community banks. These are large, pretty complex institutions with very large numbers of deposit accounts.
So I think we have time for one more question. Bert?
Thank you, Marty, for your remarks. You talked about what the potential consequences were of Washington Mutual or WAMU's situation, but I'm wondering, when we take a look at even a smaller situation, I think of First Frontier in Greeley, Colorado, that was liquidated in 2014, had some serious economic effects. Are we possibly at a point where we need to be realistic as a nation and politically about what the downsides are of liquidating a large bank, and specifically trying to impose losses on uninsured depositors? And are we possibly at a point where the federal government just basically has to throw up its hands and say, if there is a financial crisis, if there's a large financial institution in trouble, we have to protect, the federal government has to protect all of the liabilities of that bank and not just insured deposits?
Yeah, look, that's obviously the deposit insurance coverage is a statutory standard established by the Congress. So in some sense, the question you're asking, if I may say, is a bit above my pay grade. The coverage was, as you know, significantly increased during the crisis and made permanent from 100,000 to 250,000, which was a very substantial increase and reduced the number of uninsured depositors. It's a tough policy call as to whether the notion of large depositors not being protected is designed to ensure a measure of depositor discipline in terms of placing deposits at institutions. That's a long-held value that really goes back to the creation of the FDIC in 1933. So I'm not going to suggest that we should have unlimited deposit insurance in the United States, but we clearly need to be very conscious of the risks involved when you're dealing with the failure of institutions with a large amount of uninsured deposits, because it does present a risk.
Great. I'll add as a coda, the increase in that deposit insurance limit wasn't in my opinion, a deeply articulated and debated moment. It occurred, for those who may recall, after the first proposal of what is known as TARP was voted down in the House, before the second version was brought back. So the original proposal for TARP, which was voted down, did not contain that. And it was only after the crisis metastasized, after the vote, that was added by Congress, functionally to get more votes, because you weren't going to pass any piece of legislation without the votes. Join me in thanking Marty for his...
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.